Hey, what's up everyone? It's Linorth and you're watching my price action course on my YouTube channel Trading with Linorth. In this video I'm going to talk about the market cycle, so let's get into it. The market is always in a never-ending cycle between trends and trading ranges. It goes from a trend to a trading range and from that to another trend. That's all the moves in a nutshell. When you look at the chart at any moment, the market is in one of these two states. It's either trending or it's in a trading range. When the market is in a trading range, it could break out in either direction. It could trend up or trend down. It doesn't matter in which direction the market was trending before it entered the trading range. The next trend can still break out in either direction. So since every trend happens right after a trending range ends, naturally every trend consists of a breakout phase, which is the breakout from that trading range, and a channel phase. The breakout phase can be a very sharp move, usually in the form of one or a series of strong trend bars, but after that initial sharp move, the rest of the trend will move inside the channel. The channel happens when the trend starts to create pullbacks, but it's still strong enough to continue its move, and the move can be contained between two lines. And eventually the channel gets flatter and broader and create a trending range, which again breaks into a new trend. Trends can be weak or strong. The difference between a weak and a strong trend is that the weak trend usually lacks the initial sharp move in the beginning. So instead it only moves inside a channel and it turns into a trading range very soon. And trading ranges can be small or big. The smaller the trading range, the more likely it is for the breakout to be in the same direction as the trend before it. When the trading range is very small, you can still think of it as part of your trend. It can be counted as a small pullback on the trend. When the trading ranges get bigger and continue for 20 or more bars, they lose their direction. The trend is now far back and it no longer has any effect on the breakout direction. So big trading ranges can break out in either direction. They can lead to either continuation patterns or reversal patterns. The thing is that this concept is very simple, but what confuses most traders is the effect of the time frame on the judgment of a trader when they try to assess the state that the market is in at any moment. Because while the market is always alternating between these two states of trends and trading ranges, the transition can be found on the smallest scale charts like tick charts, right up to the biggest scale charts like daily, weekly, or monthly charts. Like for example, all pullbacks on your chart are trading ranges on a smaller time frame, and all trading ranges are pullbacks in a higher time frame. Alright, take a look at this chart for example. This is the 5-minute chart of gold, and you can see all the smaller parts of each state of the market cycle here. And like you can see that we had a trading range and then we broke out of that trading range with a very sharp bullish move. That's the bull spike of the new trend, and then we had a small pullback and the rest of the trend moved inside the channel, and then again we eventually broke out of that channel with a sharp bullish move. This time we had a slightly larger pullback. It's about 20 bars I think, and then the rest of the trend resumed inside a new channel. Okay, this is the same chart, but we are looking at it from the perspective of a lower time frame. I just wanted to show you that you can still find these moves in a smaller or a bigger time frame as well. It really doesn't matter. You can follow these moves and use the trading opportunities they provide for you. Okay, so why should this even matter to us? Well, it matters because if we assess the correct state of the market and can find out in which part of the cycle we are at the moment, we can take advantage of the trading opportunities of that part of the cycle. Because each part of the cycle has its own unique method of trading. For example, in a bull trend, you are only looking to buy and you should be swinging at least part of your trade. As I've said before in my Telegram channel, it's very important to trade in parts rather than just one single order. I will explain this later in another video, but let's not get away from the main topic here. Alright, so if you saw that the bullish move is just a bull leg in a trading range, then you should also take advantage of the sell opportunities as well if the trading range is big enough. In a strong bull trend, you need to buy the market immediately. If the stop has to be far away, just trade smaller sizes to justify the risk to reward ratio. And when the trend gets weaker and enters the channel phase, if the channel is super tight, you should still treat it like a breakout. But if the channel was wider and broader, you should try to buy at the bottom of the channel, and if the swings are big enough, you can also sell the channel from the top of the channel as well. It's the same for the bearish moves too. If the bearish trend is strong, only look to sell the market, and if it created a tight bearish channel, treat it like a bearish spike. And if the channel was weaker and swings were big enough, then treat it like a trading range. I will explain how to trade each part of the cycle efficiently in depth in another video. Alright guys, this is where I will end this video. I hope you enjoyed watching it. If you like this video, please like it and give it a thumbs up. And if you haven't subscribed to my YouTube channel yet, please subscribe so you get notified when I upload a new video. Alright, have fun trading everyone.